Joining us now, Ryan Detrick, Chief Market Strategist over at the Carson Group. Ryan, great to have you with us. We had the jobs report on Friday, obviously. This morning, what we're seeing weaken as the morning goes on is technology, particularly the likes of an Apple, some of the high flyer sort of semi names like an NVIDIA and AMD. What do you make of the markets here?
Yeah, thanks for having me and good morning. It's interesting. You had great discussions this morning. One of the things we've heard so much about, right? Breadth is weak. And yes, some of the high-flying tech and communications have led, but something really interesting that just happened. We saw more than 93% of all stocks above their 10-day moving average. Now, what in the world does that mean? That's a breadth thrust. When we looked at that 3 months, 6 months, 9 months later, it tends to resolve higher. Here's the real important thing. A year later, we have that many stocks above their 10-day moving average since 1950. The S&P has been higher 23 out of 24 times. We are aware of all the concerns that are out there. But with overall market sentiment, and come on with you guys for a while, since sentiment's low, be open to the idea this rally since the October lows is real and can continue. We are still in that camp.
This seems like a very short-term indicator, Ryan, just because it uses the 10-day moving average. And I'm wondering, when you take that 93% number and then you overlay, how many stocks of those stocks are above their 100-day or 200-day, how does that line up in terms of the technical analysis?
Well, most of the time when that trigger happens, most of them are beneath it because it tends to happen, after sell-offs. But let's just think of it like this. We're in a 4-year presidential cycle. We know that, right? Last quarter was the strongest quarter, up about 7% on average for stocks. We gained about 7%. The fourth quarter last year is one of the strongest ones also. And take a guess, this quarter is also strong. So we're in a very bullish seasonal time frame. And it's not all about seasonals. When the sentiment is this low, that's something. But again, what's going to happen this earnings season, right? Everyone's expecting such bad earnings. We've had a weak dollar. We think that's going to be more of a tailwind. We're, again, just optimistic that we can potentially have a soft landing, maybe avoid a recession all out. I know the slowdown, the credit crunch. We understand these things that are happening. But again, the market's telling us something a little different, that the stock market leads the economy. And it's saying, maybe the second half of this year, economy could be on a lot better footing is how we see this.
So finish out the data point for us, Ryan. You mentioned 93% above the 10-day moving average. And so therefore, most of the time, a year later, stocks are higher. What is the average gain in a year?
Yeah, right about 18.5% a year later, higher 23 out of 24 times. So again, don't just blindly invest in that one data point, but it's something we wouldn't ignore. That is a buying thrust. We've seen that off the March lows until early April, a lot of these buying thrusts. So it's something we wouldn't want to ignore. And it says momentum probably continues to the upside.
If you're going to take a look at the other market indicators, the other asset classes, for instance, maybe the bond market, what would concern you about that one indicator not proving to be true over time?
Yeah, the bond market, we've got the inverted yield curve. We've all seen that. We've seen it for about a year now, right? We've heard this inverted yield curve. I'll tell you, inflation, let's just keep it this way. A lot of inflation data coming out this week. If inflation stays stubbornly high, that could be a concern. We, like a lot of people, think the Fed has one more rate hike, then they're going to kind of take their foot off the pedal. So those would be some of the concerns. But we're optimistic that we're going to get some positive inflation data this week, positive as in continue the trend lower. And that says the Fed can stop hiking. And that's another one. We can go with this through all day. When the Fed stops hiking, the last 7 times since 1980, when the Fed stops hiking, a year later, the S&P is higher 12% on average. Yes, there have been some big drops also. I'm not naive to that. But usually that's not necessarily a major risk off sign when the Fed stops hiking.
So what sectors look best at this point?
Yeah, we're sticking with the cyclical value names. I know industrials got beat up last week. Energy was beaten up. There are some good values there. We're more neutral on tech here, not, overweight or underweight, just more neutral. But again, we think the cyclical value names that have pulled back are some areas that could do well, again, as the economy probably surprises the second half of this year to the upside.
All right, Ryan, great to have you. Thanks for your time.
Thank you. Appreciate it.